So I would use a different word. I would use the word nimble for consumers. Consumers have been hit with a number of shocks over the last few years, and they have managed to navigate those shocks remarkably well. And I think it's because the shocks have not been uniform in terms of the basket of spend. So they've had some flexibility in terms of how to figure out where the prices are rising, where they're seeing more discounts. And they're gravitating to where they find the most amount of value. It's pretty remarkable to see.
I love your marketing at Mastercard. She used to write normal reports for Bank of America. Now she's at Mastercard, AI-enabled traveler.
I mean, it's fun. It's fun now. I still love talking about the Federal Reserve, but it's fabulous to also talk about these broader themes in the economy and what we can see in our own incredible data set.
You did a huge Mastercard report on travel.
We did. So it's called the travel equation. It's around three forces that are driving travel in this economy: macro, particularly geopolitics; machines, which would be AI; and then motivations, which is where you want to go, the personal motivations that drive travel. And one of the things that was really remarkable that we were able to glean from our data is to be able to understand how consumers that are utilizing AI, so we separate into two cohorts: the consumers that have AI subscriptions and a matching set of cohort of consumers that don't. And you can see how they're traveling differently. First of all, those that are using AI subscriptions spend more of their budget towards travel. And then they go to places that are off the beaten path, like things you would never have known or cities that you were not necessarily aware of. You're seeing a very high share of tourist spending in those cities from that AI subscriber bucket. So it's fascinating to see how consumers are embracing AI to find new places to travel that have more value, especially in a world with high inflation.
I mean, Paul Sweeney is the only one here with a real life.
I do. The kids are using it. Give me 5 days in Ireland. Boom. 2 seconds later, full itinerary, hotels, restaurants, everything.
Funny you say Ireland. We actually found with forward-looking bookings that from the North America, the most the highest increase in bookings for the summer is Dublin.
Yep, there you go.
So prove it out.
The kids a couple years ago was Barcelona. Now, I don't know where everybody's going. But how about there's a lot of tension in the world here in the Middle East and
of course
Ukraine. Are people adjusting their travel to reflect that?
Of course, and that's critical, right? When you think about the overwhelming force that's out there in terms of travel, it is very much geopolitics and it's the cost of travel. And that's what consumers have to manage in terms of where do they go from a safety perspective, where do they go from a cost perspective, how do they think about the availability of flights. All of those are critical parts of the equation in North America and the US, but even more so, of course, if you're staying in the Middle East or throughout Asia.
Are Canadians not coming down to Florida or going to Arizona when it gets cold? Is that still an issue?
I think that, you're seeing Canadians flock to warmer weather, whether that's Florida, Arizona, or Mexico. But no, you're still seeing a lot of movement.
All right, so I'm going to go back to your old well here. We've got a new Federal Reserve chairman here. What is he going to do with his Federal Reserve? Because he's got a little bit of pressure from the administration to bring rates down, but the data just isn't there, is it?
So we'll see. I mean, I think that's the reality, is that we are in wait and see mode, and that's probably the right place to be because we have to determine how the increase in energy prices will feed through the economy. So there's both growth dynamics and inflation dynamics. So I think for the Fed to sit and monitor the data and try to understand the transmission of the shock into the economy is absolutely the right approach. And the committee has made that very clear. They've been very vocal in terms of where they see those risks. We had multiple dissents in the last meeting, very active commentary coming out of the Federal Reserve talking about those that are leaning more towards potentially a hike being the next move, those still in the cut camp, but most that are just saying we have to see how things play out.
I don't have the chart in front of me, but I saw a chart yesterday from the Federal Reserve Bank of San Francisco that showed the flow of people in a way losing their job, moving in transition from employment to unemployment. And for the younger cohort, it was shocking, the decline in jobs, the flow out of employment into unemployment. What is Mastercard seeing on the stresses on the labor front?
I mean, for us, I'm, of course, just looking at the public labor market statistics, just like you are in terms of the BLS data, the flow data, the JOLTS data, jobless claims. So specifically to the stat that you referenced in terms of the flow of labor in and out of unemployed cohorts, earlier in the year, and really actually last year, we did see the younger cohort, higher educated, seeing a higher duration of unemployment. The last few months, that's actually come down. So I think given what we're seeing in terms of very low unemployment rate, 4.3% unemployment rate, the ratio of job openings, the number of unemployed is remaining pretty low, pretty stable. It feels to me that we're in a labor market that is pretty, frankly, stable. And you're seeing the right amount of movement in the workforce. Now, obviously, it's not even, it never is, but on aggregate, about private sector job creation running at 68,000 a month for the last 6 months. The unemployment rate, again, holding low, wage growth serving to be pretty steady. Feels like a stable labor market.
At Mastercard, you get some unique data, presumably, see how the consumers are really spending the money. Is anything jumping out at you that might be a little different than maybe we would have thought here? Because we do have this K-shaped economy. I'm not sure if you see that in your data.
So, I mean, I have a lot of views around the K-shaped narrative, which we don't need to go into right now. But in terms of what we're seeing for the total picture in terms of overall spend, of course, we saw a big increase in spending at the pump. So if you look at spending on fuel and convenience, running about 20% positive on a year-over-year basis, and that showed up very quickly once gas prices rose. So that's the pass-through of higher gas prices to the pump, to the consumer. And then if you look at the broader basket of spend, consumers are still spending at a pretty decent clip in other categories. You're not really seeing a cutback, particularly in areas that you would think like discretionary spending for restaurants. That's holding.
Okay, this is important. And folks, we got to run. We're out of time. But with Michelle, this is important. Are we more aware of the K-shaped agony because of our new social media, our new discourse, our new communication versus 50 years ago or 150 years ago? Because you're optimistic. And I hear this from people. It's just not that bad out there. And yet we're hearing it's bad out there every tick of the day.
Well, of course, there's the headlines that are coming in fast and furious across the board. And then there's the data. And when you actually look at the numbers and you see how people are spending and how businesses are investing, you see an economy that is still moving forward. And that's why for us, having this purview of looking at the data, it makes all the difference.